Big news, mate. The IMF has just cut Australia's growth forecast, and if you've got a mortgage or you're hopping to buy a place one day, this is one of those headlines that doesn't look important at first, until it starts affecting your finances. There are really two groups who should pay attention here: people already paying off a home loan and people who have been waiting for the right time to jump into the property market. The interesting part is that markets are still working out what this downgrade could mean for future interest rate decisions. A lot could change once the next inflation and jobs numbers come out, so let's break it all down in plain English and talk about what it could actually mean for you. You know how these things usually work, mate. A decision gets made or a report gets released somewhere in Washington or here in Australia, and most of us don't think twice about it because nothing seems different the next day. Then a few months later people are refinancing their mortgage, struggling to get home loan approval, or wondering why everything suddenly feels more expensive, without realizing it all started with a report hardly anyone paid attention to. That's why it's worth understanding these things before they start showing up in your bank account. So here's what we're looking at today. First, what the IMF actually said and why this small downgrade matters more than it might seem. Then we'll talk about who this really affects and who probably doesn't need to stress too much. And finally, there's another quieter change happening alongside all this. It's not directly about interest rates, but it could still have an impact on your pay packet and the cost of living. By the end of this, you'll have a much clearer idea of whether any of these changes are likely to affect you over the coming months. Just quickly though, mate, I'm not a financial advisor and this isn't personal financial advice. I'm simply walking you through what's happened and explaining what it could mean based on what's publicly available. If these issues affect your own finances, it's always worth having a chat with a qualified advisor or your mortgage broker. Alright, let's start with the growth downgrade because that's the headline everyone is talking about. The IMF is basically an organization that keeps an eye on economies all around the world. Every so often they update their forecasts to show how fast they expect different countries to grow. This time they've lowered Australia's expected economic growth for 2026 from 2% to 1.9%. Now, at first glance that tiny change doesn't sound like much at all, and honestly the number itself isn't really the important part. What matters isn't the number itself, it's why they've lowered it. Think of it like a car easing off the accelerator. The car's still moving forward, just not as quickly as everyone expected. The IMF believes inflation is taking longer to come under control than expected, and because of that Australia might need a longer period of slower economic growth before inflation settles back where policymakers want it. Unfortunately, that can also mean unemployment stays a little higher for a while. It's not about the economy falling apart, it's more about slowing things down enough to get inflation under control. That's broadly consistent with what Reserve Bank officials have been saying, that bringing inflation back under control is likely to take time. Now here's the bit that's probably most relevant if you've got a mortgage. Interest rates don't change overnight just because one report comes out. The Reserve Bank looks at a whole range of data before making its decisions, and right now the next inflation figures and employment numbers are probably going to carry much more weight than today's headline. So if you're on a variable rate, or you're thinking about fixing your mortgage, those are really the numbers worth keeping an eye on over the next few weeks instead of reacting to every headline that pops up. And mate, every time a growth forecast gets downgraded, people immediately start asking if we're heading into a recession. That's not what's happening here. Australia's economy is still expected to grow. It's just expected to grow a little more slowly than previously forecast. That's a pretty important difference. So instead of worrying about whether everything is about to collapse, it's probably more useful to ask yourself how comfortable you'd be if interest rates stayed where they are for longer, or if they moved again sooner than expected. That's the sort of conversation worth having with your lender, not something worth losing sleep over. Now, while everyone has been focusing on that IMF report, there's another change happening quietly in the background that hasn't received nearly as much attention. This one comes from Australia's latest federal budget rather than the IMF, and it affects pretty much every working Australian. The government expects spending to rise to around 26.8% of Australia's economy during the 2026-27 financial year, up from about 26.2% only a couple of years ago. That might sound like a pretty dry statistic, but it actually matters because it's happening at exactly the same time the economy is slowing, and inflation is proving harder to bring down. Some economists argue that if government spending stays high while demand remains strong, it can make inflation a bit more stubborn, which in turn could mean the Reserve Bank has to keep interest rates higher for longer than many households are hopping. So what does that actually mean in everyday life? Well, if you're working for wages, it can feel like every pay rise gets swallowed up by higher living costs before you even notice it. And if you're running a small business, you could be dealing with higher borrowing costs while your expenses keep climbing faster than your income. Different situations, same underlying pressure. When you put both of these stories together, there's a pretty clear pattern. Nothing dramatic happened this week. There wasn't some massive announcement saying mortgages are about to become more expensive or that your pay rise won't stretch as far. Instead, it all appeared quietly inside a couple of reports that most people will never read. The funny thing is the people who pay attention to these quieter signals usually have more time to prepare before the effects start showing up. Everyone else tends to notice only after it's already affecting their finances. So to wrap it all up, mate, the IMF has lowered Australia's growth forecast to 1.9%. It's not a recession forecast, but it does put a lot more attention on upcoming inflation and employment data, because that's what could influence future interest rate decisions. At the same time, government spending is continuing to rise, and some economists believe that's making the fight against inflation a bit more difficult, which could keep pressure on households and businesses for longer. The tricky part with all of this is you rarely know straight away whether you made the right financial decision. Whether you fixed your mortgage, refinanced, waited to buy a home, or went ahead anyway, you usually only know if it was the right move months later. That's exactly why it's worth understanding what's happening now instead of waiting until it's already affecting your wallet. If you've got a mate with a mortgage, or someone who's been saying they'll talk to their broker one day, send this video their way because these changes are worth knowing about before the next round of data comes out. Do you reckon rates stay where they are for a while, or does the next inflation report change the whole conversation? Let me know in the comments, mate. I read every single one. And if you want straightforward breakdowns of the money stories that actually affect everyday Australians, you're in the right place.